Everybody, welcome back to another video here on Financial Friends. Today, we are going to be diving into the dividend portfolio, but most importantly, discussing why even when stocks are falling, I'm keeping my cool and buying lots more. So first things first, if you're new to Financial Friends, this is a community of people who love business, finance, and investing. Today's a video released on a Tuesday, which means we're talking dividends and the dividend journey portfolio. You could see it right in front of you here, $1,131.65. We have added some more SCHD to the portfolio over the last week or so, and we're going to continue to buy in SCHD in all of these positions, regardless of the state of the market, because I am not afraid, and I'm going to continue to average down. Now, I do want to mention before we dive into the video, everything will come full circle here at the end. Our holdings are almost in perfect weight, exactly how we want them. We want 40% SCHD, we want 10% FISROX, we want 10% Realty Income, which I'm a bit light on right now. We want 5.7% John Deere, Hershey, Waste Management, J&J, Apple, Procter & Gamble, and 3M. We have some making up to do there, but the big one was SCHD for us, cracking away at that slowly but surely. Now, diving into the state of the market and why I'm not afraid and I'm continuing to buy, we can see the Fear and Greed Index here from CNN. And what this basically says is the stock market's afraid. What is driving the market now? What type of emotion? Are people greedy? They're trying to get more and more profits, or are they fearful? And really, over the last year, besides the last month, we've been in this extreme fear state. You can see here in the last month, kind of ticked back up to fear, and now we're back into extreme fear. So, here is why I wake up every single day excited to buy, because I'm going to continue to do that with this type of market. You can see here down 25% year to date. This was as of noon or so today. I think we're about at that 24% mark now, but either way, down about 25% since January. This is great. This is a buying opportunity for everybody who is a long-term investor, and that is exactly why falling prices are good for long-term investors. You can continue to lower your cost basis, meaning whatever position you have, say your average cost of that stock, over time, you've paid $80 for it. Well, if that stock is now $60, you are going to be able to get more of that stock, buy it at a cheaper price, and drop your lower average cost. So when the stock begins to rise, you can see profits quicker, hopefully. Now, that lower cost basis, like I said, it's beneficial for the long term, so you can have a low average price paid for a stock. You're also going to be able to increase your position size faster. So taking, say, SCHD, for example, if we hop back over into my dividend portfolio, you can see that SCHD currently has a price of $67.37. Now, I have been paying over the course of the last really year now, my average price paid is $74.38. That means every single time I am buying at the $67 mark, I am lowering that average price. And so when the stock begins to rise, hopefully to $80, $90, $100, you will be able to see me make up some gains faster. I'm going to be able to increase the amount of shares I have. Currently 6.6, hopefully getting that to 7, 8, 9, 10, 11, 12. And that means I'm buying my dividends for less. SCHD is going to continue to pay out dividends. Companies like Coca-Cola, Pepsi, and even companies in our own portfolio, Hershey, Johnson & Johnson, Procter & Gamble, they're going to continue to pay dividends out, especially those dividend kings like Procter & Gamble, 3M, where else are we looking here? Johnson & Johnson. They're going to continue to pay dividends out regardless of their share price. At least they've done that over the last 50 years, which means every single time we buy a share at a cheaper price than it was 2-3 months ago, we're still getting the same quality dividend regardless of the price. And that is the t-shirt analogy. So diving into what that is. Say you walk into a store, and I've said this before for anyone who is familiar with the channel, you see your favorite t-shirt for $10. You buy the t-shirt for $10, and the next day you go back into the store, and now you see it for $5. Well, if you bought it for $10, you would definitely want to buy it for $5 because it's cheaper. But what happens with stocks is people tend to believe that because the share price is decreasing, it all of a sudden is a bad stock. It's a bad company. It's not a good value. I shouldn't do it. I'm never going to make money on it. And they're afraid. But when they walked into that same store and the price was $12 for their favorite t-shirt, meaning the price that they paid $10 initially, it's now went up, they buy more. Seems a little backwards, doesn't it? Sale prices are normally a good thing. And in stocks, they are too, so long as you're purchasing good quality companies. Now, moving forward on my plan, what do I plan to do? Buy stocks. That's what I plan on doing. I am going to be buying stocks. Now, how long am I going to be buying stocks for? You can see here this chart. And currently, at my current age and current time, I'm 20 years old. And I'm hoping, fingers crossed, to be able to retire by 50 years old, which is about 30 years away, and of course, shoot for the moon and land among the stars. Now, between 20 and age 40, I'm going to be doing what I said on this earlier slide. Buying stocks. That's it. I'm going to be buying stocks. Because if I believe that the share price can increase over some 5-year period higher than it was before, then why should I not buy? Even at age 35, even at 40 on the nose, I have 10 years to eke out gains. And if you think, well, it's been such a bad year, you might not be able to do that. I know. There are lost decades. There are instances in which that could happen, but let's take a look at the last 5 years, which I know might be an anomaly to some, but it does prove a point. There can be gains over 5 years. Zooming out is crucial. When in doubt, zoom out. You can see this maximum view here. Look at this. So any 10-year period, for the most part, you would have been able to eke out some form of a gain, especially if you dollar cost averaged throughout that 10-year period. I mean, you're buying at the lows of the lows. You might be buying at the highs of the highs, but you're buying at the lows of the lows as well. And so over the next 20 years, my goal is to accumulate, buy as many shares of stock as I possibly can, and build a massive amount of assets. Just like the t-shirt analogy. If I was going to buy it at 10, I'm still buying it at 5. And I'm probably even going to pay 12 for it because I believe over the next 30 years, it could go to 50. And I'm going to continue to average in. Now, once I hit age 40, I have about 10 years to retirement. Now I'll kind of know my time frame, maybe what I'm looking to do. Maybe I have a home at that point, some other assets to leverage. I'm going to begin to watch prices, how much I'm buying, etc. So I might not be buying as much of Apple at its probably peak when they might not have as much to grow 20 years down the line. So I'm going to kind of keep an eye on things as I move towards 40. But that's pretty much been the topic of today's video. Buy, accumulate, buy more, okay? But because we are nearly in weight with almost all of the positions in our portfolio, I want you to comment down below where you think we might need some more exposure moving forward. This next dividend journey video is going to be a year in review. We'll have had the portfolio for about a year now, so I want to know before that video, or maybe in that video as well, where you think we need to add some more. So here's the portfolio. It's pretty much been the same now for a long time, maybe even like 6 months. I'd have to look back, but the portfolio stayed pretty much the same. Do we need some more exposures in the energy sector, which I don't really think we have any other than probably tucked in there in SCHD and FISROX? Should we get some exposure to financials, or should we get more exposure in tech, consumers, consumer staples, consumer defensive, you name it? Put it down below in the comments. Thank you so much for tuning into this video. I hope you did enjoy. I hope you learned something new, and I hope you will hit subscribe and join the friend group. We're now past that 1,000 subscriber mark. Thank you all so much, and I will see you all in the next one. Take care.